This is a euro, a €1 coin. On one side, a map of Europe. On the other, a national symbol, German eagles, French trees, Italian artwork, depending on where it was minted. 20 countries share this currency. 350 million people use it daily. It's the second most traded currency on Earth, the second largest reserve currency in central bank vaults, the symbol of European unity made tangible in metal and paper. On January 20th, 2026, this coin bought $1.11 American dollars. Today, 5 days later, it buys 87 cents, 24 cents, 22%, in 5 trading days. Currency moves like that don't happen to major economies. They don't happen to reserve currencies. They don't happen to monetary unions backed by the collective resources of Germany, France, Italy, and 17 other nations. They happen to Argentina. They happen to Turkey. They happen to countries where the markets have decided that the institutions defending the currency can no longer be trusted. The markets have decided, and what they've decided is that the European Monetary Union, the project that was supposed to make war impossible and prosperity inevitable, is ending. Not might end, not could end, is ending. The repricing has begun. The only question now is how violent the unwind becomes. Here's what they're not telling you. The euro didn't collapse because of one event. It collapsed because of a sequence of events that, together, broke the fiction holding the currency together. The fiction was always the same, that Germany would pay. That when the debts of Southern Europe became unsustainable, when the deficits of France became unmanageable, when the banking systems of Italy required rescue, Germany would write the check. German taxpayers, German savers, German export surpluses recycled into bailout funds that kept the Eurozone intact. This fiction survived the Greek crisis of 2010. It survived the Italian banking crisis of 2016. It survived the pandemic emergency of 2020. Each time Germany complained, negotiated, extracted austerity commitments, and ultimately paid. The European Central Bank printed euros with German implicit backing. The European Stability Mechanism dispersed loans that everyone knew would never be fully repaid. The transfers happened, disguised as loans, obscured by accounting fictions, but real. On Monday, January 20th, Germany stopped paying. At 8 a.m. Central European Time, the German Constitutional Court in Karlsruhe issued a ruling that had been anticipated for months, but whose implications weren't understood until markets opened. The court declared that the European Central Bank's transmission protection instrument, the unlimited bond buying program created in 2022 to prevent sovereign debt crises, violated the German constitution. The program enabled transfer payments not authorized by the Bundestag. It must be terminated. The TPI was never used. It didn't need to be used. Its existence was enough. The mere promise that the ECB would buy unlimited quantities of Italian or Spanish or French bonds prevented markets from attacking those bonds. Why short Italian debt if the ECB will bid against you with infinite euros? The TPI was a nuclear deterrent. Its power came from the threat, not the use. The Karlsruhe ruling removed the threat. The court didn't strike down bond purchases that had already happened. It struck down the promise of future purchases. It told markets that the next time Italy or France faces a debt crisis, Germany will not authorize the ECB to intervene. The deterrent vanished, and markets moved immediately to test what happens without it. This is where the lie becomes unsustainable. To understand why the euro is repricing, you need to understand what happens when markets stop believing in collective European debt. Italian government debt stands at 2.9 trillion euros. That's 142% of GDP. The Italian government spends 4.1% of GDP annually just on interest payments, more than it spends on education. At current rates, Italian debt is sustainable only if interest rates stay low and GDP grows faster than debt. Neither condition holds. Before Monday, Italian 10-year bonds yielded 3.8%. The spread over German bunds, the premium Italy pays compared to Germany, was 1.6 percentage points. Elevated, but manageable. The TPI promise kept spreads from blowing out. By Wednesday, Italian 10-year yields hit 6.4%. The spread over bunds reached 4.2 percentage points. At those rates, Italian debt dynamics become explosive. Interest costs consume a larger share of the budget, deficits widen, debt grows faster, yields rise further. The spiral has no natural stopping point. France is in the same trap. French debt stands at 3.2 trillion euros, 113% of GDP. The budget deficit is running 5.5% of GDP with no credible plan for reduction. French yields, which traded at a 0.5% premium to Germany before the ruling, now trade at 2.1%. France is being repriced as a credit risk for the first time since the Eurozone was created. The ECB cannot intervene. Not because it lacks the tools, it could restart bond purchases tomorrow, but because Germany has withdrawn constitutional authorization. Any ECB intervention that triggers another Karlsruhe challenge puts the entire European legal framework at risk. The ECB is paralyzed. The institution designed to defend the euro cannot defend it without Germany's permission, and Germany just revoked permission. When bond markets break, currency markets follow. The euro's collapse from $1.11 to 87 cents isn't about trade balances or interest rate differentials. It's about capital flight. Investors holding euro-denominated assets are selling, not because the assets have become worthless, but because the currency those assets are denominated in is becoming unpredictable. At 3:15 a.m. Eastern on Thursday, the Bank for International Settlements recorded 147 billion euros in euro sell orders against the dollar in a single 4-hour window. 147 billion euros. The largest concentrated currency selling since the 1992 ERM crisis that ejected Britain from the European exchange rate mechanism. The selling came from everywhere. Sovereign wealth funds in Asia reducing euro allocations, pension funds in America rebalancing away from European exposure, central banks in the Middle East converting euro reserves to dollars and gold, hedge funds, obviously, accelerating the trend. The ECB intervened at 6 a.m. Frankfurt time. They spent 34 billion euros in foreign exchange reserves buying euros. The intervention slowed the decline for approximately 90 minutes. Then selling resumed. By noon, the euro had broken through 90 cents. By close, 87 cents. The ECB has approximately 500 billion euros in foreign exchange reserves. At Thursday's intervention rate, they can defend the currency for 15 days. After that, the ammunition is gone. The markets know this math. They're testing how much pain the ECB will absorb before surrender. Less than 72 hours remain before European markets reopen Monday morning. Over the weekend, emergency meetings are scheduled in Frankfurt, Brussels, Berlin, and Paris. The agenda is simple: prevent the Eurozone from disintegrating before the February 1st ECB policy meeting. 11 days to save a monetary union that took 30 years to build. While one side defends, the other side calculates. The countries being repriced are not passive victims. They're making calculations of their own. Italy's Prime Minister, Giorgia Meloni, called an emergency cabinet session Thursday evening. No statement was released. But Italian media, citing anonymous sources, reported that contingency planning for euro exit has been activated. Not implementation, planning. The technical work required to reintroduce the lira, redenominate contracts, manage the transition. Work that takes months, but that Italy apparently began months ago. France is having the same conversation. Marine Le Pen's national rally, polling at 34% for the next election, has long advocated Frexit, French withdrawal from the Eurozone. President Macron's approval rating sits at 23%. If the crisis continues through spring, early elections become likely. A Le Pen victory would put a Eurosceptic in the Élysée Palace, with a mandate to renegotiate French monetary sovereignty. The Eurozone was designed without an exit mechanism because its architects believed exit was unthinkable. There is no Article 50 for the euro, no legal procedure for leaving. The assumption was that the costs of exit, bank runs, contract chaos, sovereign default, would always exceed the costs of staying. That calculation is being revisited. At 87 cents to the dollar and 6.4% bond yields, the cost of staying is no longer clearly lower than the cost of leaving. For Italian exporters, a weaker domestic currency would boost competitiveness. For Italian debtors, redenomination would reduce real debt burdens. For Italian politicians, monetary sovereignty would provide tools, currency devaluation, independent interest rates, that Eurozone membership prohibits. The unthinkable is being thought, the speakable is being spoken, and markets are pricing in a probability of euro breakup that was 0 a week ago and is no longer 0 today. This is what a currency union looks like when the political foundation cracks. The euro was always more political than economic. It was created to bind Germany to Europe so tightly that war would become impossible. To give France a voice in German monetary policy. To provide Southern Europe with German interest rates and German credibility. The economics never quite worked. Germany runs perpetual surpluses. Southern Europe runs perpetual deficits. Germany needs a weaker currency to stay competitive. Southern Europe needs a stronger currency to manage debt. The single interest rate that's right for Germany is wrong for Italy. The single interest rate that's right for Italy would overheat Germany. These contradictions were managed through transfers, disguised, indirect, politically denied, but real. German surpluses funded Southern deficits. German savings flowed to Southern banks. The imbalances persisted because the political will to maintain them persisted. Karlsruhe's ruling announced that the political will has limits, that German courts will block transfers their parliament didn't authorize, that the fiction of European monetary unity cannot override the reality of German constitutional law. Once that announcement was made, the currency repricing became inevitable. The euro without German backstops is not the euro that investors held for 20 years. It's a different currency, riskier, more volatile, backed by institutions whose authority to act has been circumscribed. The 22% decline isn't panic, it's rational repricing of fundamentally different circumstances. Some will watch the euro fall and wait for the ECB to stabilize it. We'll trust that emergency meetings will produce emergency solutions. We'll assume that what took 30 years to build cannot unravel in 30 days. These are the same voices that said Greece would never need a bailout, that said Cyprus was contained, that said Brexit wouldn't actually happen. European crises have a pattern: denial, delay, inadequate response, then larger crisis requiring larger response. The pattern is playing out again in real time at accelerated speed. Others will recognize what Karlsruhe's ruling actually means, that the implicit guarantee underlying European debt has been withdrawn, that the ECB cannot print euros without limit to defend peripheral bonds, that Germany, the only country with the resources to save the eurozone, has legally constrained itself from doing so. The informed are not predicting euro parity or euro collapse or eurozone dissolution. Predictions require certainty that doesn't exist. What the informed recognize is that the architecture has cracked, that the rules have changed, that a currency trading at 87 cents reflects not temporary panic, but permanent repricing of risk that was previously hidden. This is not financial advice. This is not a recommendation to short the euro or buy dollars or take any position based on European political developments. This is simply an observation about what happens when a constitutional court tells markets that the backstop they assumed existed does not, in fact, exist. The euro was worth $1.11 on Monday. It's worth 87 cents today. The difference, 24 cents, 22%, represents the market's assessment of what German legal constraints mean for European monetary stability. 11 days until the ECB meeting. 72 hours until markets reopen. 500 billion euros in reserves against selling pressure that consumed 147 billion euros in 4 hours. The numbers don't balance. The politics don't reconcile. The institutions designed to defend the currency cannot act within the legal constraints now imposed on them. This is what the end of a currency union looks like. Not a dramatic announcement, not a midnight declaration, just a court ruling, a market reaction, and a repricing that reveals what was always true beneath the surface. The euro was a political project that required unlimited German commitment. Karlsruhe just defined the limits. Everything else, the selling, the intervention, the emergency meetings, the 87-cent price, follows from that single fact. And that fact cannot be reversed by central bank policy, or emergency summits, or strongly worded communiques. Germany said no. The markets heard them.